Welcome to the Big Skinny with Lou Basenese on a bloody red Thursday afternoon. A few technical difficulties, but what else can you expect on a day like this in the markets? Coming to you live, not from Brooklyn today, but from Ponte Vedra Beach, Jacksonville Beach, Florida. Got delayed coming back, and guys, we figured it out. We found a way to always be here. Even if we didn't want to be, it'd been way easier to tune out. So what's the Big Skinny about? Well, it's about giving you the straight dirt on what's going on in the markets, the financial news, the headlines. If you look up the Urban Dictionary definition of the Big Skinny, it refers to it as insider information. And I'm here to tell you once again, time and time again, we are not going to give you insider information because that would be illegal, my friends, and put us in the state penitentiary in an orange jumpsuit. What we are going to do is give you essential market truths, what matters in these markets, what you need to know beneath the headlines. I like to think of us as the Dave Portnoy of pizza reviews, but for financial and investment news. Yep, everyone knows Dave's stick. One bite. Everyone knows the rules, except Dave never takes just one bite. Dave usually takes 2 to 3, unless it's a pizza that's really bad. So we're going to do a similar rubric here for how we digest what's coming at us in the markets. It's going to come with one headline that you should ignore or maybe think twice about, one chart that you'd really need to have a look at that reveals the key insight. And then we're going to share that one insight. And how does this impact your bottom line, my bottom line, and how we behave in the market? So we do that every week. We do that in our newsletter as well. We also welcome to the show every week a CEO or a new technology trend leader so that we can bring to you things that are going to lead the future markets higher. We want to put them on your radar before anyone else. And then time and time again, we're going to bring in a market pro, a fellow analyst, someone that brings more wisdom to the table than me and maybe some gray hairs. I've got a few too, but look, it always helps to invest in the company of friends, to compare notes in the company of friends. And as I always like to say, you need to be humble in these markets, or these markets are going to humble you. And a lot of us are getting humbled today. No pun intended. But man, if we could cue up the music, it would be the end of the world as we know it. And I'm just fine. I'm telling you, I am just fine. And by the end of today's show, I want you to be feeling the same way and share the perspective that gives me the confidence to go, you know what? Tariff, trade wars, who cares? We got this. And there's a reason why. So let's get right to it. Before we do that, remember, we are live streaming on multiple platforms and you can chime in at any time. Tell me I'm an idiot. Tell me I'm crazy. JD Durkin already jumping the gun. Can you push the button that makes stocks the other direction, please? Yes, sir. Oh, sorry. I spilled my barbecue sandwich sauce on that key. It doesn't work right now. JD, you got to hit it on your machine, my friend. It's your turn, not my turn for that. So let's get to the rundown. Again, chime in. You can be funny. You can be not nice. I'm a thick-skinned Italian from North Jersey. I can handle it. So swing it and bring it. Don't look now. We got $2 trillion in market cap wealth erased in a blink. And if you're like most people reading the headlines that came out of Bloomberg right now, you're freaking out. You're a little panicked. Why in the world am I so calm then? Well, let me tell you, perspective matters. Keep some perspective in this market, folks. In the last 12 months, the S&P 500 is still up. That's right, up 5%. If you're a retiree that's been busting your butt for your entire life, saving since age 14, and you now find yourself in your mid-70s, and you've been investing faithfully all along the way, all is not lost. Like my friend and Fox News, Fox Business host Stuart Barney likes to always complain about his Microsoft that was, above $400. That man is in at about $25 cost basis. So all things considered, it could be a heck of a lot worse. Let's be thankful it's not. But let me rewind it even more and say to you, why should we be worried if it was a bad quarter, if it could still be a good year? And history shows us that is indeed what happens if we look at bull markets. We have a bad first quarter in the new year of a new president, and it tends to happen where the next 3 quarters lead to rallies. If we look at bull markets that last over 2 years, we actually have the same occurrence that happens. We have a rough start about 2 years in, and then the markets go on. The last, I think it was 11 times we've had bull markets that have made it to the 2-year mark and then have continued on. Analysis from Bespoke Investment Group. If you're not a subscriber, I have no affiliation with them whatsoever. It's just tremendous insights and data slicing. You see, again, perspective matters. While the day may be bad, the month, the quarter, and the year can still end very well. I look at it like this. Why are we worrying about what's not working when we can be looking at what is working? And I look at the market right now twofold. What is working? Well, being a long-term investor is still working, and you're getting bargains on things that you may have wanted to buy but forgot to and didn't get a chance to. Mag 7, anyone trading at 38 times earnings maybe 4 or 5 months ago, and now trading in the 20s, the low 20s. I mean, think about this as an opportunity to rewind the clock in cases like Apple to 6 months ago, when you could look to buy the stock at this current price. So you're getting a chance to, again, to buy back on the cheap. If we think about this too, if we worry about a recession coming, which these tariffs, if they last too long, will indeed cause a recession. But here's what the problem is. If we wait for the recession to be called, if you look at this chart here from the great Charlie Bielio, I don't remember or don't know if I'm pronouncing that right. Chastise me if I'm wrong. If you know the man, love to have him on at some point. If you look to wait for the NBER, the slow bureaucratic agency that officially designates recessions, you're going to have missed out a lot on the rally. So again, recession imminent? Not sure yet. Depends on how long the tariffs last. We're not even 24 hours in. We're about 24 hours in. That's it. If they only last 3 days or 3 weeks, I tell you, the back half of the year is backloaded with a lot of dry powder and fuel for this market. So again, perspective matters. What should we be doing? Thinking about the things we wanted to do 6 months ago that didn't have the cojones to pull the trigger on. What else should we be doing? Look at what's working. This is a surprise probably to many. The top performing sector in the S&P 500 this year, drum roll, please, anyone? Energy. This is a trend that I pointed out after President Trump won the election in November would be a persistent and growing trend as we moved into this year. And it's happening outside. If we exclude today and today's mayhem, the energy sector is up roughly 10% year to date. It was up 4% in the month of March, belying and betraying the underperformance of everything else in the market. Look at the tech sector, down 10%. Look at consumer discretionary, because we're worried about a recession, down 12%. But energy is outperforming. And that, my friends and fellow patriots, is not an accident, right? It's not just about drill, baby, drill. This is the future of what's happening, no matter what happens in the world. And I will show you in another chart here before long. No matter what happens in the world, we need energy to power it. And we can't provide that through all the big growth in solar and wind and hydro. So I also have a guest today that will talk more about energy and give you insights in there. If you have some green leanings, this is a green stock, a clean tech, green tech play that could also deliver in the bottom line in the portfolio. So let's get back to the rundown. Don't look out there and freak out, but look at innovation, because it leads to appreciation. We covered this in last week when we were looking at biotech, which is down, bottoming out, battered, beaten, bruised, like the rest of the market, and now is catching up to it too. But again, innovation leads to appreciation. And if you look at the Bloomberg headlines again, it's pointing out the strong performance that we've seen from the energy sector, right? It's belying the market pull down because, one, people see it as an inflation hedge. Energy, real estate have traditionally, gold, been inflation hedges. They're defying the market turn down. And I think that is a positive sign that we need to be focusing more on. So really, what does it get to? Here's what I'll tell you. We are in a supply constrained market, whether we like it or not. And if you look at energy demand and across whatever it is, fossil fuels, oil, gas, natural gas, coal, hydro, nuclear, it doesn't matter. We need more of it. If you look at the global life expectancy, we don't have to debate how many people there are going to be in the world. As Elon Musk has elucidated, the birth replacement rate in many countries is going sub 1. In South Korea, it's almost going sub 0.5. It's about 0.64. But here's what isn't going lower anytime soon: life expectancy. The longer we live, the more power that we need. And if you are privileged to live in the developed world, your refrigerator uses about 437 kilowatt hours per year. Most of the undeveloped world, they're lucky if their entire life uses more than 5 kilowatt hours per year. So think about that. What do we deserve that they don't deserve? Nothing. Right? We all deserve the same. And that's why you see persistent use of fossil fuels to elevate and bring abundant life to other countries and societies. That's not going to stop, no matter if we have another great recession, no matter if we have another pandemic. Knock on wood, folks, we don't want any of those. But here's the thing. Energy is going to be an ever-present part of this economy, of this global economy. It is what makes the world go round, and it's not just for electricity. In fact, only 20% of energy uses is for electricity. It's for transportation. It's for heating and cooling and industrial applications and food processing and everything you can imagine. So energy should be in your portfolio. And here's the funny thing. When we're supply constrained, guess what people and companies get busy doing? Innovating. Innovation is the necessity is the mother of innovation, as the saying goes. And that's no different here. If you look at our money chart, it shows that if we look at the price of oil and we see spikes because of supply constraints, it's not a coincidence that that coincides with the percentage of GDP per country in the International Energy Agency's countries cohort, their investments in R&D going up. And look at this. We see, again, coming out of the late 70s crisis, you saw a tremendous amount of investment going into R&D. We're seeing it again as percentage of R&D represented by GDP is increasing in the last decade. I'm here to share with you one of those energy innovations that can save a lot more efficiency, lead to better returns, better emission profiles, et cetera. But at the end of the day, we want to be looking for energy investments. The sector's already performing. Look, you can take the easy button, put the easy button approach, buy the ETF, the XLE. It's going to give you great exposure to multiple names in the energy sector to play this trend. Going into today, you would have been up 10% instead of down 10% if you were weighted in technology. Individual names you can play. We're going to talk about two of them at least today. One of them is one of our advertisers, my employer, Prairie Operating Corp, just came out with Clear Street guidance, sell-side analyst with a $16 price target for a $4 and change stock. Folks, that's a four-bagger built in if this company just does what we say we can do and executes on bringing that production forward, which is happening. So look, a lot of opportunity in all the red out there. I look forward to an episode or two from now when we're looking backwards and going, man, those are great buying opportunities. And we didn't get scared. We actually got aggressive and started buying. So rounding out the rundown, we want to talk about Tesla. Tesla talk is cheap. I got in a Twitter spat with a good friend of mine. Yep, I'm going to call it Twitter from these days on forward because it's always Twitter, just like Meta is still Facebook to me. With Kenny Polcari, because he told me that Tesla is more than a car company. No, it is not, folks. When you generate the majority of your revenue from one product or one service line, you are nothing else. We can buy into the hope and the hype that is Elon Musk, and that it's going to save us from this. If you look at the headlines right now, Tesla stock is cratering supposedly because of Musk's political ambitions and involvement, his politics, his work at Doge. Not the case, my friends. It's the demand destruction for EVs. We've reached the critical adoption 20% before we can cross the chasm. You look at deliveries, it's not just down because of Musk's politics and protests against him. It's down because of demand. And as much as you want to tell me that we're all going to have robots in our homes by 2028, and that's going to drive their business, or we're going to have self-driving cars on the road by 2030, that's not going to happen either. This is a automaker that's been auto and extremely overpriced by most investors, and it needs to get repriced. So again, if a company generates the majority of its revenue from one product, I mean, think about Apple. Forever and a day, everyone complained. It's all about the iPhone. It's all about the iPhone. Want to know something? Apple only generates 51% of the revenue from their iPhone now. Over 20% comes from services. I think about 27%. You can go 7 to 9% in wearables. Tesla is now over 80%. So you can tell me it's an energy and storage play, but it's not, because that's only about 10% of the revenue. And if you take out the subsidies, it'd probably be back down to 5 to 6%. So my boy Kenny and I will have another friendly debate at some time. We're good two paisans that can argue over a good bowl of pasta. Fusili, you see me, you don't. The Tesla is not going to recover anytime soon. I think the hype and all that has gone into that, just like Newsmax stock, the IPO runs up and it's coming back down when reality sets in. Same with Meta. Look, if you want to play advertising, you play Meta. If you want to play AI or the metaverse, whatever that is, you don't buy Meta because it doesn't exist. It generates 1% of their revenue. So that's it for the rundown for today. Paying attention. We are going to take a word from our sponsor before we take a quick break and bring in the CEO of Clearsign Technologies, an up-and-coming microcap play that is ready to show the world exactly what it can do from a business fundamental standpoint. So with that, we'll take a quick break from a word from our sponsor. Attention investors, are you looking for a high growth opportunity in the energy sector? Well, look no further than Prairie Operating Co., trading on the NASDAQ under the ticker PROP. As America's premier high growth, low cost oil producer, Prairie Operating is making waves in the DJ Basin in Colorado, not the Permian, but the DJ in Colorado. With a recent transformative acquisition, they've expanded their footprint to nearly 55,000 net acres and increased daily production by over 25,000 barrels of oil equivalent. Prairie Operating is poised for explosive growth, maintaining a strong balance sheet while delivering value to shareholders. Don't miss out on this exciting investment opportunity. Do your homework, do your diligence. Full disclaimer, I work for Prairie and I am a shareholder, but Prairie Operating Corp. Check it out, PROP on the NASDAQ. Again, past performance does not guarantee future results. Consult your financial advisor before investing because this is not personal investment advice. We'll be right back. Welcome back to the Big Skinny with Lou Basenese. It's a sunny day here in Florida. It's a rainy day in the markets. But again, don't be down, don't be out. There's a lot of opportunity out there. Remember to join the conversation with us today. Any questions, biting criticisms, or opportunities that you're seeing out there that you think other investors and myself should be looking at, don't be afraid to share it. Sharing is caring, especially in these times where we can look for good opportunities on the cheap. And speaking of good opportunities on the cheap, I am excited to bring in a CEO of Clearsign Technologies, who I know very well because of my long-term involvement with the company as an investor, going back almost, over a decade now, when they were just really an idea and trying to bring it to market. And I'd like to welcome in the CEO of Clearsign, Dr. Jim Deller. Jim, pleasure for you to join us today. Thank you.
Yeah, Lou, thank you very much. It's good to see you.
Yeah, listen, I know most people think in this world of Trump that there's nothing good about green technologies or clean tech that we've traditionally referred to it as, because they always thought of it as subsidized innovation, right? I think Clearsign, what's always interested me is this is one of the only technologies I've ever come across that actually is economical and is a cost benefit to adopters. It's not a cost of compliance, it's a benefit. So why don't you, just to get us started, tell everyone, what does Clearsign do? What exactly are your innovations in the energy space?
Yeah, thank you. So we have a broad range of projects, but they really have one fundamental basis, and that is we have a unique intellectual property that allows us to control flame chemistry, not to get into the details, but the critical pollutant from flames is controlled just by mixing and the structure of the device that controls that flame. With that, we're able to replace standard equipment and enable our customers to get down and meet the regulations they have to comply with in a very economical manner, rather than having to buy some very expensive, what's the incumbent equipment. And then the other key to that is where they are capped, that their operations are limited by the amount of NOx emissions they're allowed to produce. By switching out the equipment, we can allow them to produce more stuff. They can get more done under that NOx cap because we can produce much less NOx as they do their work.
So you can comply, and I think this is important for reviewers to understand. The distinction here is you're combating the emissions creation before the combustion happens. You're addressing it then instead of after the fact. You're trying to control the flame, shape, size, heat, density, all those factors to reduce emissions so that you're not trying to play pickup after the fact and try and catch all the pollutants that are emitted. Is that an accurate, generalized
It
description?
is, yeah. I mean, the standard equipment in the industry is a catalytic converter unit that fits on the back end of the client's equipment. It takes the NOx out after it's made. Well, just like your kids, it's much more efficient not to make it in the first place.
Yeah, no, and let's talk about how do these products, where do they fit in, right? I mentioned you fitting into the energy space very nicely, and I know your product line has been expanding, which is important, as are your sales. Just reported the largest annual sales for the company.
Yep.
But for the benefit of our viewers, what are your main products and where do they fit in terms of the energy landscape?
So, well, at the name, we're getting a bit into details, but the process heaters. So process heaters are the main heaters in oil refineries. So oil refineries are our biggest customer, the petrochemical plant that make chemicals. We're expanding our product line. Right, we're selling into the gas production, the midstream business. And then we have an extensive business in boilers. That is every industrial user of heat. Think of food processing, recycling plants, big municipal buildings, schools, government buildings, things like that. So anywhere that uses heat for either processing or to do what they do, it is really a potential, because and the equipment that our equipment fits into the equipment that uses that heat, whether it's for boilers or processing oil or making chemicals, but pretty much everywhere.
Yeah, and so this is a retrofit technology, right? This is not something where you have to rip out all the old equipment. You're replacing the old burners, but it's fitting right into the existing equipment that's there. Is that accurate for most cases?
It is. We've put a lot of focus as we develop this technology to make sure that it's easy to install. So you take the old ones out, it just matches the hole, it matches the bolting patterns, you can plug ours right back in. And then the same for the operation. We've had to focus on making sure that it operates just like the old equipment, so that the users, the operators, and the control systems all work very well with the new equipment, just like the old.
Yeah, and I think what's important, we showed the stock the chart there for a little bit, and it's painful. I know, CEOs and investors get judged by the price every day. This is a screaming bargain in my mind. That's not a raving buy endorsement by any means. Please, people, do your own research. But look, you're on a run rate now with sales, which you guided for, and I will give you credit. Dr. Jim Deller came on into a very tough situation, rationalized the product lineup, found new sales channels, and started ramping up sales. But you're on track, correct me if I'm wrong, to reach break even, which is a rarity for small and micro caps, especially in the technology space. Do you still feel comfortable in that guidance with the current cash runway?
We do. I mean, that's our goal. We're on. I believe we are on track for that.
Yeah. So as investors, I think it's important to understand too, you have big markets that you're addressing. So not just in the refinery space, but industrial boilers. You've also rolled out some new products that open up new markets. Why don't you talk to us about that? So the core technology is now expanding into additional markets. What does that opportunity look like, and how quickly can you get new sales in those markets?
Yeah, we started. I joined in 2019. We focused on what we could commercialize quickly. Those are the burners going into oil refineries and the burners going into industrial boilers. We've recently got into the midstream gas market. We rolled out a brand new burner about a month ago. It's called the M1. That is a incredible burner, and I've got a technical background. That's probably one of the most exciting pieces of technology that I've seen.
Your technical background, I want to pull back because maybe that'd be a little bit of understatement. If I remember correctly, you did your PhD studies in NOx formation. So you've been literally doing this and have probably seen every tech that's come across in the last 30, 40 years. Is that accurate?
That's pretty accurate, yeah.
Yeah. So you're saying this is the best burner you've ever seen. And just for context, what makes you say, what is there traditionally a lot of innovation that comes in this space? For the benefit of viewers, help them put this in context so that they understand the gravity of that and that statement coming.
So for the big picture, the industry in general has been very incremental in the way that burners have been developed. I used to work for one of the big three in the world. I left to join Clearsign because the Clearsign burners were a radically different type of technology. In fact, it's the first time I've seen a very different way of controlling emissions and structuring a flame. That's what led me to join Clearsign. This new burner now has taken that technology or that flame formation, the structure and the mixing that the standard Clearsign burner work uses. And with the aid of our new computer modeling, has completely reimagined that and achieved it in a different way. And just the results of the burner, the efficiency is up, the NOx emissions are down, the controllability of the burner is up and down, the operability of the burner is up, and the efficiency in the heater is up. It's one on every single.
Checking all the boxes. So, and look, I think again, more context has always helped to have a friend tell people about it too. Is, you came to Clearsign from a very big job running Callidus burners, which I believe was over 100 million in sales. So you left an established player in the market to come to a startup based upon the promise of this technology. And would you say that now is coming to fruition, that what you anticipated, like this M series burner is now part of what you originally anticipated?
Well, really the whole Clearsign business, getting the refining burners and the boiler burners established, the new aim burner is really exciting, just the opportunities we see for that. And then we've taken the technology we have and the IP, and recently we started developing proposals and working with clients to actually produce big systems projects. So essentially you'll take the burner technology as the heart of something much bigger, but increasing the scope and providing the vessel and the structure around it. So in terms of a commercial perspective, you're taking a $100,000, $200,000 piece of burner technology and turning it into a $600,000, $1+ million supply of a system.
Yeah, that's a 5 to 10x. I think us investors would take that anytime if it was in a stock. I want to get some questions here. Again, I want to let everyone know you can join the conversation. Please bring in your questions. Looks like Bill here has written in, and it's a little hard to read. Bill, where's your font size? There we go. You've done an awesome job technically, but the business side is looking like landing a 747 airliner on a 500-foot runway. This development of the business side is running out of runway. Well, I don't agree with that, but Jim, how would you respond to that? That people are questioning the cash flow turning. I look at the revenue, but I'll let you answer first, and then I'll put my analyst hat on, and we can bat this around a little bit.
I think the understanding is in the market. When you're selling to companies like oil refineries, it takes them, they're very conservative. It takes them time to evaluate a technology and to get used to it, and then to take on those proposals. And even once you start on a project, it takes months for those projects to go through. So always the ramp up was going to be slow. We've got significant projects in the industry now. We have some very significant projects on the deck ready to be installed. We have a 20 burner supply on the deck in California waiting to be installed just after mid-year this year. We have another 26 burner project that's moving into the production phase, also due to be scheduled just after mid-year this year. These are major projects in the industry. These are going to get the attention of the major players in the refining industry, and they're for the major players in the refining industry. And then the rollout of the additional projects that we have, and especially things like the midterm business going back to the M1, those projects are great because they turn much quicker. So we're starting to get, it's expanding, but it's starting to come together.
Yeah, it's a trickle then a flood. And I mean, as an investor that's been following the name the story a long time, and your progress, I can see it happening. And I think part of that comes down to how you came in, and the company was originally just trying to get kind of one-off demonstration projects to then have the validity to bring in customers and go direct sales to those customers. You've really opened up the sales channels by partnering with companies like Zeeco, Cal Boiler. Why don't you talk about that? How many different sales channels? How are you getting pulled into the market versus trying to push into the market?
So the different products is working different ways, but this was right from when I joined. This strategy was that a goal is to keep the company asset light. Zeeco is almost $1 billion company plus or minus. It's a global company with global manufacturing. To sell into the refining industry, you need certain industrial resources that a small company like Clearsign just can't provide. So we collaborated, formed an agreement with Zeeco that allows us to use their facility. They actually manufacture the burners for us. So the burners are built with their credentials. And then recently we have developed that collaborative agreement. So it's actually now becoming a Zeeco Clearsign dual branded burner that is it's on the Zeeco website. We've done teach-ins and promoted that to the Zeeco sales team. And now this $1 billion company, they're oil refining process burner sales team is out there promoting Clearsign technology, enhancing the capabilities of what they've got to promote. And for Clearsign, we've got a massive sales team through that channel now promoting our process burners.
Yeah. It's a game changer. And I think we got another question here that's going to come at me, rightfully so, that I'd recommended the company probably about 7 years ago. What makes it different now? Essentially, I think you advised buying it already 7 years ago. If the tech is so good, why did this company succeed? I would tell you this, like, the company is succeeding. And here's what I've learned in my time. You can be early, but it has as many letters as being wrong. And I was wrong on getting the timing. And I think that's the hardest thing with technologies. And so what I've learned in my process now is really seeing sales traction. And this is what Clearsign is demonstrating finally. And I can say with the perspective of knowing that Jim brought that about. The company was previously run by management that I don't like to disparage people that just didn't do a great job. They were kind of scattered shot with the technology approach. Jim came in and rationalized that. He, to his credit, said it was going to take some time. It took the amount of time that you suggested, Jim. So, I mean, we got to applaud successes there. And now you're seeing it in the sales. So as you look out, I want to leave final word to you, Jim, because I see this as a unique opportunity. Again, in micro and small caps, there's a lot of volatility like we see in the markets. It gives you opportunities to buy in and take profits and sell out and come back in. And I think this is a great time to come back in. But why are you so optimistic about what's ahead in this year for the company, regardless of what's happening in the market today?
Yeah, I think you define that with key markets. I mean, we've just formed this latter stage agreement with the Zeeco sales team. So looking for, first of all, the inquiries to come in through that team, and the next five proposals are getting the sales through that Zeeco team and ramping that up. That's not going to be a 1 or 2 month process. We had our investor call yesterday. I gave some indications that realistically those orders may be towards the end of the year into next year. That's the scale of business. But bringing on that resource and having Clearsign technology marketed under the Zeeco name by Zeeco is a really big deal. Getting these big system projects out, getting these $1 million orders out rather than $100,000 burners is a really big deal. When you look at our revenue, that is hugely significant for Clearsign. We haven't sold any yet. We do have them engineered. We're having conversations with customers. So I can't tell exactly when they'll come in, but I do believe we're going to bring some of those in the future. That'll be a big expansion of our business. Getting into the midstream industry. This is a wide and varied industry. The technology, I think we've hit a sweet spot. I think we've really found an opportunity for Clearsign there, especially with the M1 burner. I think we're going to see a lot of growth in that industry. And then with the new technology like the M1, I really think that is adaptable, maybe into new process burners, probably into boiler burners. We're working on that now. So I think that there is a lot of potential on different fronts. We're growing and diversifying that product line.
Yeah, no, look, I'm excited. I'm encouraged by the traction that you're seeing in the last year, you and the team. If you're okay with it, I'd love to keep abreast of your developments, have you come back on as you have major announcements to let everyone know. And look, folks, you saw the chart. The stock was trading for $1.50, $1.60 not long ago. That's more than a double from here if the market turns around and just starts realizing. So there's a lot of potential here, but it's being realized, and I think we'll see more of that. So Jim, again, thank you for taking the time today, and look forward to the next conversation on the big news for the company.
Fantastic. Thank you, Lou. Hey, I appreciate the opportunity.
Anytime.
Cheers.
All right, folks, we're going to take a word from another one of our sponsors before we take a quick break, and then we'll be back. Looking for top quality, fully custom golf polos and lightweight quarter zips? Well, you're in luck. Butcher Golf has you covered. Take your brand, promotion, or special event and bring it to life with full cut and sew customization, starting from a blank canvas. Order as few as 25 or as many as you can imagine, delivered to your door, and get this, 21 days or less. Butcher Golf, fully custom, really fast. Visit butchergolf.com today and mention the Big Skinny or the Sweet Lou discount and see how much you get off. We're going to be right back, but please, if you haven't signed up for our newsletter yet, scan the QR code or go to thebigskinny.com. We are back to the Big Skinny with Lou Basenese, coming to you from Florida today. Be glad I am, because it sounds like there's a foghorn up in Brooklyn going on. So it would have maybe caused some ruckus for you. But hey, this is the part of the show where I bring in a good friend, a market pro, to really share their insights, to educate me. Last week, we had Anthony Pompliano to educate me on crypto and try and change my mind. This week, I have a dear friend, a closer friend. He's not the mouth of the South. He's got the smoothest voice around. Frank Curzio, a fellow paisano. Again, thanks for joining the show, Frank.
Thanks for having me on, man. It's great to see you.
And you've seen it all. You've done it all. You used to work with Jim Cramer. You've built your own research company. We've worked together at research initiatives. I mean, let me just start with it, right? Like, you've seen every market condition. What do you do in this time? What are you telling your subscribers? What do you tell your grandmother when she calls and says, Frankie, what am I buying today?
I think what was, and thanks so much, Jeff, for having me on the show, but I think right now it's more about buying individual stocks, individual ideas, where everyone's looking at where the market's going to go. And it's so represented by the Mag 7, which is, largest 7 technology stocks that, whatever direction they move is which direction the S&P is going to move. The NASDAQ, of course, is filled with technology stocks. So there's just a lot of individual ideas that make a lot of sense here. But I've always said uncertainty is the death of stocks and the markets. And I can't remember a time in my 30-year history doing this where it's more uncertain, even during COVID, even during the credit crisis. And the reason why is when you look at the Fed odds of what's going to happen in terms of rate cuts, right now, if you look at a percentage of what they're pricing in for no rate cuts, 2 rate cuts, and 5 rate cuts, they're all the same right now, which is telling you that.
I mean, look, go back 2 weeks ago and it was trending towards 1 to 2. Now we're seeing, like you said, 4 to 5.
Yeah.
How do you make heads or tails of that? Like, what do you see? I mean, when you see that, what does that trigger in you? Like, okay, what am I have to adjust? How am I looking at the world tactically now for investing?
It means that stocks have a lot more risk since there's much more uncertainty. Because if you look at those scenarios, it's pricing anything from a deep recession to we're going to see growth 6 months from now. Like, we're still going to see strong growth. And investing under those conditions, if you see a recession, fine. You could buy the staples. Staples doing good today. Less of the cyclicals, right? So when you have this confusion of what's going on, it's difficult to say, okay, here's the bottom. I mean, I thought Dell might have been a good buy yesterday. It's down 20% today. Best Buy might have been a good buy. It's gotten annihilated. It's down 15%. So you have to be very careful here. But what I will say about the tariffs, I think they're short-term in nature.
Yes, agreed.
Take the politics aside. And a lot of countries are hating us right now, and I don't blame them. But with the U.S. being the most powerful nation in the world, and you're looking at other economies where I was 27, 28 trillion GDP, and we're looking at Mexico at 1.5. We're looking at Canada 2.2 trillion. They could play a tough, they could say whatever they want. They could be tough in the media. But the bottom line is they're looking at depressions where we're looking at a pullback and a mild recession.
Well, you're right. We live in a relative world, and currencies, interest rates, I think you're absolutely right. I mean, it's painful now. I guess my question is, and I kind of brought this up on Fox Business last week, is like, show me one MIT wonk or nerd that can build a model that calculates whether these tariffs are in place and at what levels, 25%, 35% for 16 days and 2 hours, or 3 days, or like you're seeing already in the run up to yesterday's announcement, some of these nations saying like, hey, we're ready to compromise now because we found out you're not serious. You're not messing around, that you are serious. And so now we got to compromise. So like, I guess it's that question of how do you, let's assume worst case scenario, these tariffs stay in place for long enough to really impact the market, the economy. Where do you go to buy then, right? What's an attractive individual name? Again, talk your book freely. Sharing good ideas here. Like you mentioned consumer staples. Is there a consumer staple stock that you love that is recession resistant? Is it a healthcare name? I mean, or do you get opportunistic and try and buy in increments in discretionary names because they're going to rebound eventually?
I think the names to avoid right now are the names that are closer in ties to China, because I think that tariff situation is a lot different than we're looking at Canada and Mexico, right? So I would stay away from the Nikes. I'd stay away from the Apples. I'd stay away from the Starbucks. I think they're going to get nailed even further. One name I really like right now is Tesla. I've never really said that. I've traded back and forth. I could tell you one thing that's not being factored into Tesla, right? Because everyone knows, if you tell me everything that's wrong with Tesla, what's factored in, I don't know if you could tell me a risk that nobody knows right now. But I can tell you that's not being mentioned in the media every day. I could tell you with these tariffs and what they're doing, that last time 2018 tariffs with the auto companies, Mexico folded, Canada folded, and China folded. They were like, okay, we'll invest more into your industry, into the economy. and that's fine. And it went away and everything worked out. No inflation, stock market went up 2 years over 40%, GDP went higher. This time around that he implemented, he actually did it.
Yeah.
What it does to legacy carriers is they cannot produce an EV that's profitable, that's barely profitable in the US, but they pushed all of that production along with their truck production in Canada and Mexico.
Yep.
The fact that they're going to get hit the hardest, they cannot bring that. They have capacity right now in the US where they can bring some of that production back to the US, the Fords and maybe Stellantis, and you're looking at GM. But what I'm looking further down the line of how these companies, you basically shut off your competition. And it's going to be great, not just for Tesla, but for Rivian, because Rivian's the only other name in the industry that can actually scale EVs. The legacy carriers
So
can never scale
you see
EVs.
this as they just got a big moat put around their EV business because
Yes.
everyone else got boxed out because of the tariffs.
Yes. And I know
So
the risks. I know what's going on, and people are key in Teslas. I know that, people
yeah,
worry
it's
about.
totally wrong and inappropriate. Like lock
Yes,
them up and throw away the key. Like that's
exactly.
un-American.
Mhm.
So I guess my question is, because I'm more on the other side, like Tesla's richly valued no matter how big the EV demand is. And I worry about EV demand destruction, just like we've just gotten to a point in the market where you pulled forward all the early adopters and now you're trying to
Mhm.
mass market it. How do they get mass market adoption?
This is going to be hard. This is going to be hard for some people. I'm a fundamental analyst, as you know, by
Yeah,
trade. So telling you that the numbers don't matter. But if you look at Tesla's routes history, it hasn't traded on valuation. And I've made that
agreed.
mistake in the past. And you've probably seen it most because you cover technology. The best guy I know covers technology. What did I make wrong? What did I get wrong in Netflix? Netflix was just this booming company. I said the same thing. Wow, this company just has a crazy valuation. I'm going to stay away from it. It went up 10,000%.
Yeah.
What I got wrong is I was comparing that company against competitors in the industry like cable companies. And what I got wrong is I shouldn't have been comparing it that way as a fundamental analyst because their total addressable market wasn't against a cable company. It was every single cable company trying to compete against Netflix because they
Yeah.
want another level.
It's a
So when I
good
look at
point.
Tesla and justifying that valuation, it's yes on a PE ratio, you say you're crazy. Yes on a price to sales ratio, you're insane. It's never traded on that because it's much more than that. Where legacy carriers are talking about how do we get production in, you have Tesla talking about robotics and robotaxis,
Yeah.
right? It's a different level where the EV production and how they're able to produce EVs and scale them, still legacy carriers can't do it.
Yeah.
As we push more into EVs, I'm not the biggest fan of EVs, but I'm just saying you're eliminating a big competitive hurdle through these tariffs where they can't compete. And you're going to take a lot of these cars, EVs off the market. That could be good for Tesla. And I haven't seen anyone really talking about it. So I think that could factor into
Yeah, no,
how
look,
it's
I'll
traded.
give you credit. At the top of the show, I was kind of banging on our friend Kenny Polcari for saying, well, about the robots and energy storage. You're sticking with the auto play, which Tesla is. So I
Mhm.
respect that. I've learned never to short Tesla. I did it one time successfully. I don't do try and tempt fate twice.
Mhm.
But this is the thing I love about you. You said, hey, this is what I got wrong before on Netflix. You're an
Yeah.
honest, straightforward
Yeah.
guy. I sit on the other side of Tesla, but I'm not going to dare short it. So maybe we make a better wager. Let's just keep track of price of Tesla today, price of Apple. I'm going to say that I bought a share and you bought a share. Let's see who does better in about 6 months.
That's
We'll
great.
come back on and we'll say, and I'll say, why I was wrong. I know I'm not
Mhm.
afraid to say it, but hey, I want to thank any other thing that you think is top of mind, and then that investors really need to know in a market like this, and then how do they get your insights regularly, just as opposed to just coming on here for 10 minutes. I want them to know how to
Yeah.
find you.
I really appreciate that. I mean, look, I think small caps have been decimated. I've never seen a market that has gone up. If you look historically, and you cover small caps as well,
Yeah.
where large caps have this much of a gap when it comes to the outperformance of small caps, and now they're down tremendously today in this market. You're seeing companies. Listen, not every small caps. The Russell 2000 may be a buy, whatever, but when you look at an individual level of some of these companies, where a company like that I hated, Dave and Buster's, of where it's trading right now. I mean, they just
Right.
showed that they could sell their real estate, and their real estate's probably worth about 6 times its market cap, and they actually own the real estate, right? That makes
Yeah.
it good for a private equity investment company to come in. So I see limited downside, new management team. You have insider buying. Like, I'm looking for insider buying because sometimes you don't have to wait for the technicals to go up. And
Yep.
I know sometimes you'll want to see, okay, it moved off its 200-day moving average. It's up 15%. I'm going to get in. When you see insiders buying, they only buy for one reason. They sell for so many numerous reasons, which we've all
Amen.
read in 20 million textbooks. But that's what I'm looking right now, where not only are these things down tremendously, they have U.S. exposure, tariffs, they shouldn't be hurt as much. A lot of these guys were reshaping their businesses over the past 2 years because they underperformed. So they shed a lot, they cut costs dramatically, focus on the core businesses. a company like Play looks really good to me. A company like Roblox, they just signed a great deal with Google. Everyone who signed this deal with Google, even Reddit, this stock is absolutely taken off. You basically get unlimited to their cloud and everything, and they're going to steal all that information. And they give the API and the keys away, which is what these companies do. And Google's great at that, whether you like them or not, politically.
Yeah.
And
I like the stock as a Mag 7 is probably one of the most undervalued, underloved ones. But so you love small caps. I'm with you there 100%. I think individual stock selection is key, as you noted, right? S&P 500, you back out those 7 names. The other 493 are actually pretty flat for the year. They were doing much better.
It's amazing, right? It's a great
it's
stat.
crazy that how 7 influences the index so much. So I'm behind you on that. How do people find you, right? I mean, aside from X, what's the best way to get your research on a regular basis?
You can just go to curzioresearch.com, and we have a podcast I've been doing for 15 years called Wall Street Unplugged that you've been on, and hopefully you come on a lot more, that I've been doing for 15 years. Actually, I took it over for Kramer, and it's been downloaded, I think 16, 17 million times in over 120 countries.
15 years faithfully.
Which humbles, it's crazy. Like, I'm like, how can so many people, you gotta be crazy listening, but it's really cool. It's humble, and it gives me a great benefit to hear perspectives from you, like Tesla. Like, I want to come back in Tesla and see what I got wrong, what I got right. That's what we want to do with investing.
Agreed.
Limit our risks, challenge ourselves and get better. And, we'll definitely revisit Tesla and see who's right on it. And regardless, it's not going to be, I told you so. It's going to be like, how do we learn from it? And that's how
I agree, man. That is well said. And listen, man, I hope the Big Skinny can reach 15 years. Dude, we're on episode 5.
I'm sure you will.
Dude, I don't even know how you keep it straight. I think I was on maybe 9 years ago the first time. So listen, man, always a pleasure. Look forward to chatting with you again soon, Frank, and good luck on every name, including Tesla. I hope I'm wrong, because I'm not going to short it. So you can win and I won't lose, and I'll be happy.
Well, listen, thanks so much for inviting me, and good luck with everything. I know the podcast will be a success. So you're great, man. I know you for a long time. You're awesome. So.
All right, man. Thanks, Frank. All right, everyone, we're going to have one more word from our sponsor. But before we do, make sure you're signed up for the newsletter, scan the QR code on the screen, or go to thebigskinny.com. We'll put it in your inbox. One headline, one chart, and one investment insight. We'll be right back. Business moves fast, and so does search, especially now with AI transforming how customers find you online. If your business isn't optimized for AI-driven search, you're missing opportunities every day. Incend Media is more than marketing. They're strategic growth partners using advanced answer engine optimization, cutting-edge SEO strategies, and proven business analytics to help your company generate new leads, attract more customers, and solidify your brand's presence. In the era of AI, visibility equals profitability, and Incend will ensure your business stays ahead. Visit incendmedia.com today, and don't forget to mention the Big Skinny to get your free SEO performance audit. With Incend Media, your growth is just a click away. Be right back. Welcome back to the Big Skinny with Lou Basenese. We're in the Dodd block. Dodd, what are you feeling today, man? It's a rough day in the market. You wake up and what do you do? What do you say?
I don't know, man. It's a bloodbath out there. My choice is try not to watch it. That's
Yeah,
what I'm trying to do the best. But it's going to come back. It's always come back. Glass half full is it's coming back.
listen, man, I said it earlier in the show, right? Down, in the last 12 months, you're actually up 5% if you're just playing the S&P 500. So there's names that are out there. I mean, if I looked out, Microsoft's at 375.58. I missed out backing up the truck at that on $250 a share, probably, gosh, a little over a year ago, embarrassingly on Fox. I was waiting for 250, it got down to 254. So perspective matters. We got a question here from Action Jackson, man. Better handle than I'll ever have. Luke, you're the Apple expert. Are they in trouble? Your thoughts on Hood? Man, these are two different divergent ones. There's no rotten apple here. I don't love it at 200. I'm not backing up the truck. The last time I really got excited at Apple was when it was trading down about $1.40, $1.50. That's the last time I made a big buy. Always buying along the way. I don't think you can go wrong with Apple. So here's another key thing, and I was going to bring it up with Frank before we get to our rundown, Dodd. Most people don't realize that institutions don't just buy once, right? They don't go like, I got 10 grand or 100 grand or $1 million. I'm buying Apple today. They buy in bite sizes, no pun intended. So yeah, if you're starting a position, I think this pullback is attractive in a lot of names. Put a little bit to work. Put 10% of what you plan to fully invest. It's dollar cost averaging, single stock averaging, whatever you want to call it. I like Apple here. Robinhood, not so much. Not a fan. Never have been. Too volatile. Too unpredictable. I don't know. When you can open up an account and use credit card for funds, I just think when things really roll over, it could get ugly. So if we do have a recession, I think it'll be very short-lived, but companies like that will get impacted the most. So that's what I got to say on Robinhood. Could be wrong. Them expanding their business is smart to get into all the types of services you want to land and expand, just like Apple tries to get more into our homes. I just don't love it as a business, but hey, it could be wrong.
Great viewer questions today.
Yeah, no, it's been great. And Action Jackson, man, come back. Let's look in 3-6 months. We can have another friendly bet like I did with Frank Curzio. We'll sign you up for a premium subscription for free if you beat me. No harm, no foul. So
yeah, during Dr. Jim Deller's interview there, I was writing down some questions, saying, I'm a Shark Tank enthusiast. I'm like, what about sales? What about sales? What are the catalysts coming ahead? And before we can even get to here, there were some viewers, asking the same question. So great to see.
They're doing your job, man. You know who's going to do it next, Dodd? AI. The robots.
Exactly.
They're coming, brother.
My internship's going to be up at the end of the spring here. So hopefully.
Listen, not when you're carrying the banner so well with our logo on your bed back there. Do you sleep with that sign? That's what I want to know.
Every night.
Could be weird, brother. Could be weird. That's all in if you ask me. All right. What are we doing? Sign up for the newsletter if you haven't already. Join the conversation. I don't care if you're on Rumble, X, Twitter, LinkedIn, where else are we? I can't remember. YouTube Live. Just chime in. We're here to answer any questions. Talk stocks. But now, what is it time for? Dumb and Dumber?
So this week's rundown. What do we got here? We got economy, stock market. I just threw up my mouth a little bit, Lou. What's going on here, man?
The stock market is not the economy, and the economy is not stock market. I think this happens a lot. People confuse it, right? Politics is not the economy. The economy is not the stock market. People think they move hand in hand, hand in glove. They don't. If you look at the U.S. economy and the S&P 500 companies that make up the 500 biggest companies in this economy, they get 30 to 40% of the revenue from overseas. So as the economy goes, yes, the market tends to follow, but not fully. And remember, the economy is not a forward-looking beast, but the stock market is. So I brought up earlier in the show that chart showing like when we got the official designation that we're in a recession, the stock market in many cases is rebounded at least 50, 60, 70% already. So don't get fooled into thinking that a bad GDP print for Q1 is going to lead to a bad Q2, Q3, Q4 for the market. It could actually be really good if we see the Fed cut or we see these tariffs go away. And, this time next Thursday, we could be talking about tariff tantrum over, the terrible twos are over, and we have a nice, respectable bull market back again.
We can only pray.
We can pray.
Facts that
burn some incense.
Please tell me you got a comic strip or something to lighten the mood around here.
Man, I wish, but if anyone, I talked about Bespoke Premium before, no affiliation. I get no cut of that. You go in there. That's one resource. FactSet's another free resource put out by S&P. They tweeted X'd. It just doesn't sound right. X'd. I truthed.
Why can't you get right with it?
Yeah. The 10 S&P stocks with the highest percentage of sell ratings, and they're on the list. You go down there, they're number 6 or so. I can respect that. They put out great insights, and they can even make fun of their company being the most shorted. So the highest percentage of sell ratings. So follow FactSet.
Value. Yeah.
Yeah. Yeah.
Let's see, a dot bomb scare. What?
Yeah, I won't say this.
Turkey boys back in town. You know, they're making some prank phone calls. What's happening here?
Hey, I mean, there was a prank phone call that was made with some friend of mine from Jersey to try and get my brother out of school one time in middle school, but that was 20 years ago. I'm not giving the details on that to incriminate us, even if it's past the statute of limitations.
Save it for another show.
Yeah, save that for another show, late night with Lou Basenese. Bigskinny.com with Lou Basenese. Make sure you're signed up. But yeah, .com bomb. Everyone's worried that we're like in for the big 2000 crash, but here's put it in perspective. We didn't have even close to as much of that run up. We're not staring down the abyss of another NASDAQ collapse and implosion where 80-90% of NASDAQ companies have no business model. They just had a .com in their name. So this isn't pets.com. Anyway, .bomb, .com. We're not having that this time. That's my take.
All right. Cyber insecurity. What'd you do? Post your social security number as your status update or something?
Nah, I did something worse. I did an interview with John McAfee, about 6 months before that crazy documentary dropped. Here's a photo of young Lou and Weird McAfee.
Wow, look at you.
Yeah, that's in a theater in Memphis. What's not shown is his prostitute wife, who became his wife, and his bodyguard that had about 9 guns on him. And me and another guy decided it would be a bright idea to interview them for our newsletter at that time. That footage has been buried to never be released again. But anyway, we talked about cybersecurity last week and said, look, you can't have a single silver bullet, one company approach to profit from cybersecurity. If you look, there's a chart put out that shows how spread out the different facets of cybersecurity are. And we talked about the digital attack surface area, that it's impossible for any one company, any one solution to protect it all. And here it is. You got a bucket, right? Identity security, app security, data, endpoints. I mean, you just can't play this with one name. I mean, you look at some of the popular publicly traded names in there. Microsoft down on the right, SentinelOne, CrowdStrike's in there. They're all there. Best way to play it was an ETF. Hack is a good one. I think in an upcoming issue, I'll compare all 3 of the cybersecurity ETFs that are out there and give people the kind of pros and cons and what are the differences. But you want to play cyber, you want to be secure in the cybersecurity space, you got to play it with an ETF and not an individual stock. All right, last thing in the rundown here before we get to it. Any other questions? Chime in. We're going a little bit over, but that's because we love you. And there was good questions and we had some technical difficulties. But before we close it out, chime in real quick last time. But what do we got for to close us out, Dodd?
Sour bears. Sounds really good, man, but I have a really bad feeling about this.
Yeah, the sour bears, I wish, I'm just going to disappoint you. It's kind of like today's market performance. It's not that good. It's just sentiment came out again, that AAII sentiment reading. Here, Subu Trade puts it into a nice graphic to show that we're at such an extreme of bearishness, 61.9% bearish reading this week. This survey comes out every week from individual investors. Look, I may not be the brightest guy in the world, but I know when everyone or almost everyone thinks alike, everyone is likely to be wrong. When 60-70% of people think we're just in a bear market and it's the end of the world as we know it. It's not. It's usually a great buying opportunity. So maybe not next week, maybe not 2 weeks from now, but I would tell you historically within a month, 6 months out, markets are usually higher when sentiment gets this high. Will the tariffs have Action Jackson back in the action? Will the tariffs help data centers, man? Good question. I don't know that I've thought through that entirely. Here's what I can tell you. It won't hurt them. Because if you look at the total data centers, and this is where my rare superpower comes in, I have an uncanny ability to remember random ass numbers, but never song lyrics. China has 483 data centers. The US has 5,321 based upon the last count. So we have a monopoly of all monopolies on data centers anyway. So it's not a bad thing, tariffs. I think the probable way that they could hurt data centers if they use certain interconnects or chips or equipment that is coming from outside international suppliers that could make them a little bit more costly, but that could be counterbalanced by more independent energy independence in the U.S. So great question, Ashton Jackson. I don't have a clear answer on it. I could tell you it's probably a neutral though. One impact would be balanced out by one benefit by being protected. So how do you like them apples?
The Rain Man numbers.
Yeah,
I didn't
dude.
know that about you.
Yeah, I know. It's weird. I didn't get my underwear at Walmart though, so that's a good thing. And
Nice.
that, my friends and fellow patriots, is the end of the show. We end on a sour note, sour bears, but I hope when you join us again, we're talking about positive news, positive reactions. Had a few stock names mentioned here today: Clearsign, Prairie, Roblox, Tesla, Hood, can't remember, Play, Dave and Buster's of all names. Maybe take a flyer on the stock, but not there with your kids for dinner. No thanks. Not a fan. But hey, we are a fan of you. We're a fan of you joining the show, interacting with us. We appreciate it. Dot, I'm a fan of you, always being a faithful fellow contributor. I'm a fan of Dan and Taylor in Brooklyn, making this happen for us every week. Folks, if you're not on the newsletter, sign up. QR code on the screen or at our web address, thebigskinny.com. We'll be here next time to answer your questions and give you the big skinny on the latest financial and investment news. With that being said, we're signing off. Thanks again.